Today we have a very unique program, the study circle on US tax and reporting obligations for US citizens, green card holders. We have with us eminent personalities CA Mithun, Raghuram, Kariyappa, and Chengappa. Can begin with the session. I request our senior member CSS Bhatt to escort the CA Mithun and present a planetary momentum. Also requesting to present it. I request CSS Bhatt to escort the Mr. Raghuram and Mr. Kariyappa into the dais and present a plan. CA Mithun is a chartered accountant from the ICA with over 11 years of experience, principally specializing in corporate taxes and regulation in India. CA Mithun is a rank holder from the CA course, securing the 21st rank in the CA final and 47th rank in the CA P2 examination of ICA. He has a wide experience working with MNCs and Indian business houses on tax and regulatory matters covering international tax structuring, private equity investment, merger and acquisition tax and controversial management in India. Mithun is a director in the tax practice of E&Y LLP in India. With this brief introduction, I present before you CA Mithun. Welcome you, sir. Mr. Raghuram Mangalampalli is a graduate from Andhra University and has over 16 years of experience in US tax compliance, focusing on for profit corporations and partnerships. Raghuram has experience in working with clients in media and entertainment, real estate and private equity sectors. Raghuram is an executive director, US GSR at the E&Y Global Delivery Services Center in Bangalore and an enrolled agent certified to practice before IRS. With this brief introduction, I present before you Sri Raghuram. Welcome, Mr. Mr. Kariyappa and Chengappa is a graduate from the Mangalampalli University and has over 13 years of experience in US individual tax compliance. Kariyappa has the experience in handling US tax for global mobility population in automobile and information technology sectors. He is an enrolled agent certified to practice before IRS. Kariyappa is a manager at the E&Y Global Delivery Services Center in Bangalore and an enrolled agent certified to practice before IRS. With this brief introduction, present before you Mr. Kariyappa. Welcome, sir. I welcome all the members for this today's study circles. Dear members, in upcoming we are having next week the study circle project reports and business plans formulation and presentation by CA and JS Pratap Giri. After that, we have 4 days a very unique program from the Bangalore branch, workshop on customs and FTP for chartered accountants. After that, we have how to use Tally ERP 9 for assurance and verifying compliances. So I request our members to make use of this all the programs. Now I will go to CA Mithun.
Good evening, fellow members. It's a pleasure to be here after a few months. Actually, I was presenting a couple of months ago here on a more familiar topic on limited liability partnerships right here. So thank you for the opportunity. I have a very small role to play, I must confess, because my colleagues Raghuram and Kariyappa will be doing most of today's talking and experts on the field. When it comes to US tax, I think a lot of us have heard about a lot of reform which has been passed by the Trump government. In December, they passed the Tax Jobs and Cuts Act, on account of which there's been quite a bit of change in the US tax law, impacting both individuals as well as corporates. It will have an impact on Indian corporates as well who are doing business with US clients as well as subsidiaries of US corporations based here. The provisions like the BEAT, etc., which can have an impact. Now, today's session is on US tax and reporting obligations for US citizens. It's about the compliances which one needs to do as an individual, as a green card holder, as well as a US citizen. Just like India, the US tax law has worldwide taxation of US individuals, and there it goes on even to green card holders who are taxed on a global basis for income which they earn globally once you get a green card. One thing I can tell you from experience, as well as I've lived in the US for a few years and worked with our US practice, principally as an India desk, that the law is very much evolved. So, for example, in India we have the Income Tax Act and income tax rules, and taxmen, etc., have just come out with those revised laws for us. If you see it from a US standpoint, a US tax profession would have about 4 times more books on their table, because their regulations would have the rule, an exception to the rule, an exception to the exception to the rule, an exception to the exception to the exception to the rule. So just reading it itself is a complex matter. Another matter you will also see is in the US you have a lot of people who specialize in certain sections in the law. There are a lot of CPA practitioners, etc., who are generalists, but they would be specialists. For example, somebody would specialize in foreign tax credits. And they would say, go to this person and he is the best person for foreign tax credits. Somebody is good at compliance, etc. So it's a far cry from a third world like us, where somebody will ask you a question on Companies Act in the morning and set up a partnership in the afternoon and go to the tribunal before it closes in the evening. So it's very, very, very specialized. So and certain other matters which will come up is that. And while my colleagues will go through that in a lot more of detail, it's just an overall general comment. We have a lot of websites like IBFT, etc., which have details about foreign taxes. And very often, if you go to, say, European legislation or even third world legislation, Philippines, whatnot, there is a good chance that just by reading a lot of material out there in the public domain, you will more or less directionally get a good answer, and then which you can confirm with with foreign tax experts. Again, experience shows that with the US, don't ever try to do that, because a same fact pattern in two different circumstances, based on what those taxpayers have elected to do, can give you diametrically opposite answers. So it's same fact pattern. You could have a US company having a Netherlands sub, having a Mauritius sub, having an Indian subsidiary. Two similar fact pattern, you can go and have completely opposite answers because of what you have chosen to do, whether in terms of check the box rules, or if you are individuals, whether the spouses have decided to combine and file a tax return or separately. So, unlike us, we could go and say Indian company having a foreign subsidiary, you have a poem risk, take care of it. From a US standpoint, it's so fact driven, and what somebody has chosen to do, that you have to be very, very careful in evaluating those circumstances. So today's objective really is to go through a little bit on the reporting side for individuals, green card holders and resident US citizens who are residents there, as well as to go through the US tax reform. So I'll hand over first to my colleague Raghuram. Please, we'll keep this at, these guys do this work day in and day out, so feel free to ask any questions you'd like. And I'll facilitate this, and wherever there are questions, I'll try and pose it from an India standpoint. Kariyappa will probably first start off with the reporting requirements, and then we'll move on to the Tax Jobs and Cuts Act of December 2017, which Raghuram will take us through. Thank you, Mithun. It's on. Let's go. Okay.
Kind of used to walk around. Good evening, everyone. So before I start talking about the US taxes, I want you people to do two things. One, think that you are in the US now. And the second one, forget India taxes for next 2 hours. So that will help you to understand US taxes a little better. So I will be referring to foreign nationals, and when I say that, it will be non-US countries, including India. So it's one item which people get confused with. So whenever I say foreign national or foreign country, it has to be non-US. Okay, looking at the objectives of today's session, you will understand the basics of individual taxes and determination of residency. Residency plays a key role in US individual taxes, because as Mithun mentioned earlier, US also taxes people on worldwide income, and also the various other factors. I mean, the elections they need to take, the kind of income they need to report, or the various forms they have to file depends on residency. And there are various special filing requirements for US citizen and green card holders in the US. And if they fail to comply with those, there are huge penalties, and those penalties might run up to like $250,000. It might be like 50% of the bank balance. And then we are going to talk about the tax reform impact on individuals as well as on corporate tax. So we have a packed agenda for the next 2 hours, and we're going to talk about the US taxation for individuals, and filing status might be something new when compared to Indian taxes, because here people file their own taxes, and in the US they have an option to file a joint tax return. Married people can file a joint tax return. And I'm going to talk about determination of residency, and I already told you why it is important. And then I'm going to talk about income recognition and the various tax forms you get to see on the US taxes. So the tax forms, the number of pages in the tax form might vary from like 5 pages to 400 pages, depending on the complexity of the tax return. And there are various additional filing requirements apart from the tax return. Some has to be filed along with the tax return, and some has to go outside of the tax return. And another key topic is relinquishment of citizenship or green card holders. I'm sure some of your clients might be like the green card holders who will be filing India and US taxes. And there are certain important things they need to know before they relinquish their green card. And the tax reform will come in the end. So this is a quick overview of US individual taxes. So US is on a calendar year basis, that's from January to December. And the original filing due date in the US is April 15th. And this year it's April 17th. So we are in the middle of our busy season, just a few more days to go. And people can get the extension. The extended due date will be October 15th. They have to file a form requesting the extension of time to file their individual tax return, and that has to be filed by the original due date of April 15th. Once they file that form, they will get automatic 6 months extension, and that extension will avoid the late filing penalty. So there will be a late filing penalty of 5% on the balance due per month, up to a maximum of 25%. So if they request for extension, that's waived off until October 15, but the late payment penalty and late payment interest will continue. Similar to India, the tax rates are on a graduated basis on a different slabs. It varies from 10% to 39.6% at the highest. And with the tax reform, it's getting reduced to 37% beginning 2018 tax year. And in the US, the individuals are also subject to alternate minimum tax. So if they are taking a lot of deductions because of their state taxes or their mortgage interest or real estate taxes, it gets eliminated when the alternate minimum tax is calculated, and they are subject to AMT of 26 or 28% based on their income level. So apart from income tax, there is Social Security and Medicare tax as well in the US. The Social Security tax is capped at $127,000, 6.2% of $127,000. That comes to around $7,886. And there is Medicare tax of 1.45% on the entire earned income. So the Social Security and Medicare tax is basically on the earned income, means wages and self-employment income. After that, there is state and local income tax as well in the US. The federal taxes are there. That's like our regular tax what we pay in India. It's similarly called as federal tax in the US. Then there is state tax returns. Every state, there are 50 states and 44 of them have their own income tax structure. And the people have to file the state tax return and pay state taxes. State taxes can vary from 3% to 9%. And there are local income tax as well in certain states, especially Pennsylvania or Ohio. So there are local income tax as well. So Pennsylvania is the earliest state. So there is a state tax, there is a local tax, there is a municipal tax. Every state has a tax there. So we were before you go to Pennsylvania and trying to check it out there. So in total they pay, if someone is at the highest tax bracket, they pay 39.6% income tax. Probably that will average out to like 30 to 33% the slab rates, and Social Security of 6.2% and Medicare 1.45% and state tax at an average of 6%. So they will be taxed around 45% on their income. So when there is so much of taxes, then there has to be a lot of deductions and credits as well. So let's look at the next slides and see what's in store for us. So filing status for individuals, this plays a key role in determining their taxable income. So as I mentioned earlier, the married people have to file, either they can file joint or separate. So single, if they are unmarried, they have to file as a single taxpayer, and if they are married, they have an option either to file as joint or separate. And in order to file married, filing joint, both taxpayer and spouse should be the full year resident in the US. So only they can get to choose, get to file MFJ or married filing joint return. So that's the most beneficial filing status in the US, because they get to club their income and tax it on one unified tax rate. And MFS taxes them separately, so even the deductions are kind of, they get 50% of the deductions and credits, and they have to file married filing separate. In some situations, MFS will be beneficial, and people do go with marriage filing separate status. And this filing status depends on their marital status as on December 31st.
Yeah. Question. You might be covering it supplementally, but MFJ you're saying only for US residents, but if there are citizens residing in India, are they not supposed to then use MFJ?
I will come to that. So in the future slides, I'm going to talk about residents who can be a resident and who will be a non-resident. Then we will get an answer to that question. So, and there is another filing status which is head of household. Usually if someone is unmarried, or there are rules to look at who is considered as unmarried. Even though they are married, they can be considered as unmarried only for tax purpose. And if they have dependents, then they can file HOH or head of household filing status. As I mentioned, these filing status are important because the tax rates vary from one filing status to another filing status, and the deductions and and credits also differs between these filing status. Now we come to the important topic of residency. So we need to determine first who is a resident and who is a non-resident, and then we get to choose what type of filing status they can have, and then we get to see what deductions are available to them and what credits they can take on the tax return and what their final tax liability will be. So a residency in US is on the basis of citizenship. If someone is a US citizen, they are always considered as a resident, irrespective of how many days they live in the US or where do they live. Even if they go to Mars, they will still be considered as a resident in the US, and they have to file a full year resident return. And they will come to know why someone is filing a full year resident return, what type of impact they will have on their income tax returns in the future slide. And the second group of people who will be considered as resident are the green card holders. So the legal term for them is a lawful permanent resident of the US, and we generally call them green card holders. And they are considered similar to US citizen for US tax purposes. So they are also considered as fully a resident in the US and taxed on worldwide income. So these two are kind of straightforward. If someone is a citizen, always a resident. Someone is a green card holder, always a resident in the US. And the third category is the objective-based test, depending on the number of days they are present in the US. I have a separate slide dedicated to substantial presence test or SPT. So if they satisfy that substantial presence test, they will be considered as resident in the US. So all the residents are grouped together for taxation purpose. So a different rule applied to residents. And if someone does not meet those rules, they will be considered as non-resident, and a separate tax rules applied to non-residents. So US citizen, anyway, we can rule out they can't be a non-resident, and green card holders, even they can't be non-resident, but there, as Mithun mentioned, there are exceptions to everything in US tax. So on exceptional cases, a green card holder can be a non-resident in the US, but that might impact their green card status. So when they take the green card, they are telling the US government that they are planning to live in the US and they will be a permanent resident in the US. If they file a non-resident return, then the immigration authorities will say, you don't have any intention to stay in the US, you are filing as a non-resident, so why don't you relinquish your green card? So, but there are exceptional cases where they can take this, but there are certain risks associated with that. And the third category is the substantial presence test. We generally apply that to the foreign nationals who come to the US. So when they come to the US for work purpose or for their studies or for research or for vacation, whatever it is, we need to look at their substantial presence test or the number of days they are present in the US, and we determine the residency. So a foreign national, when they come to the US but do not meet the substantial presence test, we call them as non-resident in the US. So this slide talks about the substantial presence test. There are two conditions associated with it. So a taxpayer should be present in the US for at least 31 days during the current tax year. When I say current tax year, it's similar to the previous year in Indian taxes. So for 2018, for today's date, the current tax year is 2017. So when I'm determining residency for someone for 2017 tax year, the first condition I need to look at is he a US citizen? If not, then is he a green card holder? If not, then I come to the substantial presence test. In the substantial presence test, I look at the first condition, whether he is present in the US for 31 days or not in the first year. I mean, that's in the current year, the tax year. So if he is present there for more than 31 days, it need not be consecutive days. It can be any day, any period from January to December. And then I go to the second condition. So in the second condition, I look at the number of days he is present in the current year, how many days he is present there in 2017. Then I go back to 2016 and I see how many days he was present there in 2016. And I go back one more year and 2015 and see how many days he is present there. Then we allocate the days, we apply the percentage to those days. For the current year days, that's the tax year days, we apply 100%. That's in 2017 if he is there for, let's say in this example, he was there for 150 days. So we take 150 days. Then I look at the 2016 tax year, there he was present for 60 days. Then I take 1/3 of that. And then I look at 2015, the preceding previous year. In that year, in this example, he was present there for 90 days. Then I take 1/6 of that. Then I add up those days or those numbers, and if that is more than 183 days or more, then he will be considered as a resident. If it is less than 183 days, then he will be considered as a non-resident. And if someone is present there for less than 30 days, less than 31 days, but because of the prior 2 years look-back rule, if he is there for more than 183 days, still he will be considered as a non-resident because he does not satisfy the first condition in this one. So this is how the substantial presence test or the residency test is looked into for the people who travel to the US for work purpose and for other various purposes. And even if someone goes there for a vacation, even those days are counted. So we count every day he is present, physically present in the US. So even he is present there for 1 hour, that will be counted as 1 full day for substantial presence test. Again, there has to be exception because it's a US tax. So few people who are present in the US can exclude their days from substantial presence test. One being the J or F visa holders. J visa is for the trainees who go from some foreign country to the US for training purpose. They can exclude their days from SPT up to 2 years. Even though they are present in the US for 365 days, their days will not be counted for this calculation because they are considered as exempt individuals for 2 out of 5 years. And the other category who use this exempt status is F visa holders, who are the students who go and study in the US. For them, the US days are excluded or exempt for 5 years in a block of 6 years. So up to 5 years, even if they are present there every year for 365 days, they won't be considered as resident and they will still be considered as non-resident. So that's about the substantial presence test, and now we should be having a fair idea as to how we determine residency in the US, who is considered as a resident and who is a non-resident. And so when it comes to the green card and the substantial presence test, a person can be a part-year resident. That means their residency starts when they enter the US or when they obtain the green card. And for citizen, obviously, they will be a full-year resident in the US. And for these two categories, we need to look at when did they arrive in the US and when do their residency start. For green card holders, it will usually be the day they obtain the green card. The day they get the green card, they will be considered as a resident in the US. Even if they are living outside of the US, they will still be considered as resident from the day they get the green card. And for the substantial presence test, if someone is a foreign national who goes there and makes a substantial presence test, their residency will start on the first day they are present in the US in that particular tax year. Let's say in 2017, in the previous example, so Sandeep goes to US, let's say on January 2nd, let's take a different date, and he goes there on April 1st and continues to live there for the rest of the year. Then he meets the 183 days test in the current year itself, and his residency starts on April 1st and continues until December 31st. And for green card holders, once they obtain the green card, they will continue to be resident, so you don't have to worry about the second year or the succeeding years. They will be fully resident there. But for substantial presence test, you have to look at this test every year. So once you have done the tax return for 2017, and he continues to live in US in 2018, it doesn't mean that his residency will continue. You have to apply this test for the 2018 tax year and see if he meets the substantial presence test. Then only he will be considered as a resident in the US for the 2018 tax year. So this rule of residency is for federal tax purpose. So the rules vary from state to state. States does not look at the substantial presence test or the citizenship or green card test for the state residency. Some states look at the domicile rule. So a person can have only one domicile at a time. So that means where his personal interest lies and where he wants to settle down or where his family is or where his financial ties are. they determine residency on that basis. So if a person is a resident of Connecticut state and he has a home there and goes on assignment to a foreign country, they may say, even though you live in the foreign country, you have a home here, your intention is to come back to the state of Connecticut. So you will continue to be the resident of Connecticut, and you will continue to pay some worldwide income in that state, and you have to file as a resident return. But some states look at the number of days they are present there. If you look at the Alabama state, it says if you are present in Alabama for like 7 months, you are considered as a resident. There will be a domicile rule usually for the citizen or resident of the US. And if someone is not a domicile of Alabama, is a person who is going from India to Alabama, lives there for 5 months, it says, okay, you are a non-resident because you lived there for less than 7 months and you have a domicile in India. That means you are planning to go back to India. If he lives there for like 9 months, then he will be considered as a resident for Alabama, again taxed on worldwide income.
And just to add a few comments from an India perspective with regard to what Kariyappa has been saying till now, I think the substantial presence test is something which has been followed in India also in some form, although we have for Section 6 which talks about tax residency for individuals. We go back 4 years in certain cases when you talk about the 60 days in the year and 365 days in the previous 4 years. It's a 3-year test so far as US is concerned. Again, from in terms, I'm just looking at points of distinction. In India, we do not tax taxpayers based on their citizenship, unlike the United States, where just by virtue of being a US citizen or a green card holder, you become a tax resident, being taxed throughout the year. And the last point really being an thanks to and we should be thankful to God. And we don't have state income taxes. Imagine paying income tax in Karnataka, Tamil Nadu, etc. And there are a lot more complications there. I mean, when if for example, corporates who are having people in different, working in different states and earning income, often they have to compute how many days an employee is spent in different states. So, all in all, I think to that extent we are not, life is not as complicated for us. But I'm sure Kariyappa will bring on points like exit tax, etc., which we do not have today. You can really plan your affairs. An Indian citizen can go and stay in Dubai and in that year earn substantial income overseas, etc. And plan his taxes. That's something which the government is now strongly looking at stopping. We've seen this CBDT setting up a high-powered committee to look at situations where tax residency is being changed by individuals so as to plan their taxes. So it seems like the broad direction seems like there will be a convergence of third world countries like us going towards more complicated tax systems, no matter what the government says that they simplified things.
Thanks. So we looked at the residency, when does the residency start in the US, and I was talking about the state residency as well, and locality also kind of follows the same rule as a state for tax purposes. And the same thing happens, the mirror image of that happens in the year of departure. If someone, we generally see the taxpayers who come to the US on assignment from their employer side, work in the US for like 2 years or 3 years, and then they go back to their home country. So that's a mobility force that's a population which I heavily focus on, the people who come into the US or US people going and working abroad. So when they end their assignment and they go back to their home country, so their residency ends on the day they leave the US or the last day they are present in the US, provided they establish a closer connection to a foreign country, which generally people do. I mean, they will have their ties in the home country and can prove to the IRS. IRS is the Internal Revenue Service, which is the tax authority in the US. You can prove to the IRS that the taxpayer has a closer connection to a foreign country and he departed the US on a particular date, and he will be considered as a resident only until that date, and from the next day onwards they will be considered as non-resident. And again, the exception comes into picture here. If someone makes a substantial presence test, I said they have to file as a resident in the US. But you can look at the tax treaty with different countries, US and different countries, and you have an option to look at the Article 4. Generally, Article 4 refers to the treaty tiebreaker. So, and even though they meet the substantial presence test in the US, you can use Article 4, you can show the closer connection to a foreign country or their home country and consider them as a non-resident in the US. This generally happens when they come to the US on a short-term assignment but still need SPT, and they will be maintaining their residency in their home country. In India they might be filing as a resident, but in the US also they have to file as a resident. So to avoid that, we can look at the treaty article, and we can apply the treaty article for substantial presence test. But the treaty article, Article 4, is generally not taken by the citizen. It's not applicable to citizens, and green card holders will not take the treaty tiebreaker for the reason I mentioned earlier, because that puts their green card at risk. And so if someone meets substantial presence test, there is an exception to file as a non-resident. In the same way, if someone is a resident, if someone is a non-resident in the US, but they want to file as fully a resident of the US, or if someone does not meet substantial presence test, but still they want to file as a part-year resident or dual status person in the US, there are elections available under the Internal Revenue Code section, and they can take that election, tell the tax authority that I meet certain conditions as prescribed by the IRS, and I want to be considered either as a part-year resident or as a full-year resident, even though I do not meet the substantial presence test. These are kind of one-time elections, once in a lifetime elections the taxpayer and spouse can make. Once they take this election, they will be considered as a full-year resident in the US. As a full-year resident, they can file a joint tax return. That's one of the main reasons why people go for these elections, so that they can file as a joint. They can file a joint return, take exemption for spouse, dependents, and get a higher standard deduction or exemption and credits. So there are various rules around the elections. I can talk about the elections and treaty for 2 hours, and there are 3 or 4 different options available to these people to make these elections. And once they make the election, they will continue to file as a resident in the US. So before I move on to the income recognition, I take a pause for any questions you have.
If visa status changes in between from student to worker in the middle of the year or not, then what happens?
That's a great question. So the exempt status is based on the visa type. If someone is on J visa, let's say from January to June, and in June he gets employment there and changes to H visa or L visa, then we exempt the days only for the J visa period. So from L visa onwards, his days will be counted for substantial presence test. Any more questions on residence?
Students serving on this OPT visa, will they be taxed?
Yeah, people who are on F visa and are allowed to work for 1 year, I believe, on OPT, an optional practical training program. And the F visa rules do apply for the OPT period, and they will be considered as exempt individuals. And the taxability depends for the students and the trainees. They can use the treaty article, and if they are paid by the home country, they can exclude that under the dependent personal service article, Article 14 or 15 of India-US Treaty. And again, if it's paid in the US, there is the treaty again says up to certain amount they can exclude the amount. I'm not sure about how much it says for India, but some countries it says up to $5,000 or $20,000. They can exclude that income, and they won't be taxed on that. If someone earns an income on J visa, their income is also exempt from tax because they will be paying taxes in home country and paid by the home country.
No, the payment is made by the US company.
Then they will be subject to tax, but they won't be subject to Social Security or Medicare tax. And they will be considered as non-resident. They pay tax only on the income they earn in the US. The employer will be issuing a Form W2, which is similar to our Form 16, and that reports the US wages and withholding, and they pay taxes.
And they should not hold any financial assets in India or any other country?
No, they can have. They will be considered as non-resident, and they won't be taxed on worldwide income, so there is no implication of holding anything in the home country.
Is the taxation of partnership firms similar to that in India, like only the firm is taxed on income and the partners don't have to pay any tax on the
Actually, partnerships are taxed as a pass-through entity. The partnership doesn't pay the taxes. The individuals, the partners get the K1.
Yes, that's it.
Yeah, Raghuram can talk more about that
Yeah.
later. And they will get a K1 which lists the partnership amount for the particular partner and they pay taxes.
Yes, that's correct. So partnerships are treated as a pass-through, or we call that as a flow-through. They are not subject to entity-level taxation. The partners in the partnership, they will receive their share of income from the entity, and they will pay tax on that.
Can an Indian citizen be a partner with a US citizen and create a partnership?
They can. So the partnership does not have restrictions or conditions on who should be a partner in a partnership. But there are other types of entities like, for example, S corporations are also treated as a pass-through, and they have restrictions on the type of shareholders that an S corporation has. Partnership does not have.
Right, but just on that particular question, you must be very, very careful if you are looking at a partnership between an Indian individual resident and a US resident, so far as India tax is concerned, because even part control and management of a foreign partnership in India will be considered as if the partnership is a tax resident in India. So India will look at the partnership and treat it as a separate taxpayer, and you will be subject to tax in India. So far as US is concerned, the partnership will be a flow-through entity, and only the final partners will be subject to tax. So you might have a situation where the US partnership is taxable in India. I'm assuming that the law will be applied in the manner it is written. You'll have a situation where the US partnership will be taxed in India, and it will have no credits at all, because the credits will be lying in the hands of the two individual partners who will be separate taxpayers. So you might get yourself into trouble.
Unless it can be proved that the entire management is with the US.
It is going to be very difficult, I must tell you, because if you look at the case laws on this matter in the past, because if you look at, earlier, prior to the POEM rule, so far as Indian companies were concerned, you would go with, the control and management of a foreign company had to be wholly in India for it to be a resident. Whereas in case of partnership firms or other SSEs, even partial control and management in India is considered sufficient for it to be a resident. So there have been case laws where have said that even right to sign bank accounts, a small meeting in India, etc., is control and management. These are very, very wide terms. And in today's circumstances, it will be very, very difficult where so much of data is available to tax authorities. And they don't even need to wait for your submissions. They can get data from 1,000 sources. You might, although the exchange control will permit you to become a partner, etc., you might want to be very careful about it.
Does similar handicap exist with the other taxable status like association of persons?
Yeah, those are type of taxpayers you should generally avoid when you do a cross-border. That's something you may want to avoid. When you get into tax credits, etc., it becomes a little complex. You might have an odd situation where you'll be okay, but all in all, cross-border structuring with, especially involving India, where taxpayers are treated differently, the systems of taxation may not be aligned. You might just have a challenge which you handle.
Yeah. And then also what would happen is that if Indian citizen is a partner in a partnership, he is treated as doing trade or business in the US, and the IRS would require him to file a tax return in the US, and in addition to whatever he has to do on the India side. Right? So Mithun and his team does the cross-border structuring, trying to avoid that. So partnerships you need to be very careful about.
The best way is for the Indian citizen to render some services, raise an invoice, and just take the money.
So you can be a shareholder in a US corporation. Right?
But are dividends taxable in US or is it completely exempt?
Dividends paid by the US corporation to the Indian company or to the Indian, it would suffer a withholding tax, right? There would be a withholding at the US. There would be a withholding, and at the Indian entity level, at the Indian taxpayer, if you were a corporate, then you could have the benefit of the 115 section and go for the 17% tax rate if you are corporate, but all other taxpayers would be based on slabs.
even with only the internet.
Thank you. Those are some of the great questions. And with that, we conclude the residency piece of the US tax. We know who's a resident, who's a non-resident, and who's a party resident in the US now. So now let's look at why it is important to determine residency. So because the resident is taxed on a worldwide income, so taxed on all income regardless of source during the resident period. A person could be a citizen or a green card holder or a person who meets the substantial presence test. Their worldwide income will be taxed for them when they are resident in the US. And because they are taxed on worldwide income, there has to be deductions and credits provided to them, so they can take all possible deductions and exemptions and tax credits when they file as a resident in the US. So they can take an exemption for themselves. The taxpayer can take $4,050 as an exemption, personal exemption. Spouse gets an exemption and they can claim their children as dependents. There are conditions to claim the children as dependent, and they have to be resident in the US. And under those circumstances, they can take personal exemption for these people. And let's say there are 4 or 5 people, then they can take 4,050 to 5 times as personal exemption. And then there is a standard deduction available to them, and individual single person can take $6,000 as a personal exemption, and married filing joint return, they get to take $12,000 as a standard deduction. So the standard deduction and personal exemptions reduce the overall taxable income. It could be their wage income or interest, dividend or rental income. So we calculate the adjusted gross income, then we reduce their standard deduction and personal exemptions. Then we arrive at the taxable income. And again, these exemptions and deductions are subject to phase out. If they are earning more, if they are earning more than $300,000, then it starts to get phased out.
One question, Kariyappa. What if the spouse is a different residential status than the other, and you want to, can you file jointly then?
They have to take an election to consider as a fully resident. So one of the basic conditions is that both taxpayer and spouse has to be fully resident to file a joint tax return. If taxpayer meets the substantial presence test as a fully resident, and the spouse it doesn't meet substantial presence test, but still they have an option to file a joint tax return. I get to see this a lot. People who go to a different country, they get married to people who are in different country. So the taxpayer is a US citizen, spouse is a Chinese person or an Indian person. They had never been to the US, but they can elect to treat spouse as a fully resident. They can file a joint tax return, and they tax the worldwide income, and they take all the possible deductions and exemptions.
If I am to a US citizen and I have an income, I write an invoice on him, will I be considered as a non-resident who is having an income from a US source, and then am I required to file an income tax return in US?
No, you are in India and you are rendering some service to the
US citizen for certain things, let's say on the same market or whatever, and I write an invoice on him for let's say about $2 lakh in a particular year. And then will I be considered, though I am a non-resident for tax purpose, will that income be considered as income earned in US, and am I required to file a tax return in US?
Yeah, that won't be considered as an earned income in the US. To earn income in the US, you are generally present in the US. Then US will have the first right of taxation because you are present there and working in the US. And then you pay taxes there. You are working in India now for a US company. That will be like you are Indian. You will be considered as a resident in India. You pay taxes in India. And at the most, if there is a taxability, then you can take TD, and you can say that you are a resident in India. You don't have to file a return in the US and not have to pay taxes.
What about the losses? Whether required to file a return for same city? No, this is governed by the DTA, right? That's what you are saying. But the DTA, the primary residence is in India. So only in India we need to pay tax, and we are not supposed to, or we are not required to pay any taxes on file returns in the US if we are present only in India and returning our services from India. That's what we are saying.
So the services are performed in India and you are in India, right? The amount is paid from someone in the US, right?
Yes.
So the services are performed outside United States, so you are not considered as doing trade or business in United States, so you do not have to file a tax return. Again, it also depends on the type of income that you are receiving. I understand you mentioned, you clarified that it is a service income. For example, if you are receiving an interest income, so you are in India, but you are receiving an interest income from US, then that would be subject to a withholding under section 1441, right? So again, in the same case, if you are here and performing services receive the money, you don't have to file any taxes. But you are performing services through a partnership entity like what you have mentioned earlier, then you have to, because you will get nexus. So, and then you have to file a tax return. Thank you.
By virtue of employment, if I receive shares,
Can you be louder, please?
by virtue of employment, if I receive shares of the US, if I sell the shares here from India, will I be taxed?
It won't be taxed because you are a non-resident for tax purpose, and the capital gain, whatever you earn during the non-resident period, is not taxed in the US. It is taxed where you have a tax home. When we say tax home, where you are a long-term resident. So since you don't have a tax home in the US, you are not taxed on capital gain as a non-resident.
Your question is an Indian resident is getting ESOPs in a US corporation and then he sells it. Is that what it is?
Yeah, the same rule applies. He is a non-resident in the US, and its capital gain is not taxed in the US for a non-resident.
But they do have withholding tax there on the stocks that they give, so that can be claimed back there in the Indian when you declare it here.
So if the taxes are withheld when the ESOPs or RSU is issued, and you can claim that by filing a return in the US, or you have to provide a declaration saying that you are filing as a non-resident in the US, and there is no withholding requirement for you. So
That's W8 pen, right?
W8 pen.
But they won't have a social security number or a PIN number. What do they use?
That's a tricky situation we have come across in few cases, and in those cases they have to apply for 19 individual taxpayer identification number, and then they can file the tax return.
But there's no way you can claim that in the Indian system you pay US taxes and you're reporting income here.
I don't think the taxes withheld in the US can be claimed on your Indian tax return as a refund.
That I get this question. So someone pays taxes in the US, right? Can I claim credit here?
I think if you go by treaty law, it is what tax have you rightfully paid in the other country which the home country will give you as a credit. So while you might want to claim that, you might want to put forth that claim, strictly speaking, if that was the other state did not have the right to, tax that income, you ought not to have paid that tax in the other state. When I say state, the other country here, so as to claim a credit so far as India is concerned. Right? So in your fact pattern, I mean, the assessing officer might have to get into, in order to dispute your credit, that whether this was really taxable in the other jurisdiction, which they usually would not. But by the letter and spirit of the law, that tax should have completely been attributable to India, and they are not getting it because you have sort of incorrectly or by your own negligence let the withholding stay. You see that very often in the other situation where Indian taxpayers, when they withhold tax, they take a very conservative view and withhold taxes. Especially when say fees for technical services are paid by Indian residents too, and most importantly the software situation as well. You withhold the tax and say you claim credit in the other country, but if the if the tax was not in the first place supposed to be paid in India, the other country should not be giving you that credit. So, I mean, it's a nuanced point, but practically you might get away with the claim, but should you have actually claimed it is questionable.
So the resident is taxed on worldwide income. So they have two provisions to claim the double tax avoidance relief or the tax relief in the US. Let's say a US citizen comes to India and works in India, and in the US he can claim the foreign tax credit for the taxes paid in India. Let's say he comes here and works here for 3 years. He will be filing as a resident in India, and by virtue of his citizenship he is filing as a resident in the US as well. And all his work days are in India, but he has to pay taxes on that in the US. So in that case he can take foreign tax credit. So we look at the US taxes applicable on this foreign source income, and we compare that with the taxes we paid in India on that income, and whichever is a lower, we take that as a foreign tax credit. And yeah.
India to follow this financial year is March, and there is a calendar year. How would this mismatch take place?
Okay. Yeah, there are two options or two methods to claim foreign tax credit in the US. One is paid method and one is the accrued method. When we look at the paid method, we look at the actual taxes paid during the calendar year from January to March. Sorry, January to December. That includes your tax withholding from your salary and TDS and other stuff. So whatever is actually paid, irrespective of which year it relates to, whatever is paid in the tax year can be claimed as a foreign tax credit. If someone follows the accrued method, then we wait for the calendar year to complete here, sorry, the financial year. If I am filing the tax return in the US for the tax year 2017, then I take the accrued liability from 2016-17 tax year in India and claim that on 2017 US tax return.
It's almost like individuals are on a cash basis, cash method, right?
Yeah.
They are on a cash method, no input.
Tax credit is available for full tax, cess and surcharge, everything, or only tax, basically?
Surcharge is also, I mean, we can take that as a, we can consider that for credit.
Not cess.
We consider the surcharge and cess except the penalty and interest they pay. So we take the full taxes.
It has to be in the nature of income tax. So if it qualifies and treated as income tax, then it would be eligible for a foreign
In
tax.
case of Indian tax structure,
Yeah.
you generally have these three slabs of taxation.
Yeah. So the cess is actually not a, I mean, if we can look at it in more detail. I have not looked into the Indian scenario, but if the cess is a tax on your income or is it a tax on your tax,
Tax on tax.
then it is not in the nature of income tax. So whatever is the foreign tax credit, for example, we get into a lot of issues when it comes to even to the dividend distribution tax, right? So is it income tax eligible for a foreign tax credit or not? So it's these are very nuances, as Mithun has mentioned, nuances that we need to look into the treaty and the specific transaction and then determine whether it qualifies for a foreign tax credit or not. But that can be disputed easily.
Right, I think the question on dividend distribution tax being creditable, although it is a matter of opinion in the US, I think now from January 1st it's becoming academic because dividends are exempt in the US based on the tax reform, correct? So in terms of a credit, this is the Indian company structure would become a very costly structure for US subs because the dividend for most practical purposes are not taxed at all.
So there won't be any withholding tax in future?
It's not, we are talking about India repatriating to the US, so it's the other way around.
Oh, but no, from the US corporation, if I receive dividends, will there be a withholding tax?
Oh yes,
Yes.
that did not go. Yes.
That continues. The withholding continues, but we were talking about
Okay. So one is the foreign tax credit to reduce the tax burden or to avoid double taxation, and the other option is when someone goes to a foreign country and gets paid there for the services he rendered, the wage income. So US allows something called as foreign earned income exclusion. If someone works in a foreign country and gets paid there, and up to $102,000 will be excluded as foreign earned income exclusion. So that's straight away a deduction from the total income, and on the rest of the income you calculate the taxes. And if you apply
Federal tax, not a state tax.
not for state tax. States do not allow foreign tax credit. Very few states allow foreign tax credit, probably 3 or 4, which I remember, and most of the states don't allow that. And once you calculate the foreign earned income exclusion, so you can't use the taxes paid on that portion in a foreign country for FTC purpose. So your FTC gets reduced. So you have a reduced FTC, you have foreign earned income exclusion, and then you can file the tax return. So that's about the taxation for resident and the provisions available to avoid double taxes. And non-resident are taxed on the US source income. Usually they are taxed only on the effectively connected income in the US, which means they are taxed on their wage income or their self-employment income in the US, or the dividends issued by the US corporation. And they will be taxed at the effectively connected income will be taxed at graduated tax rate. Any other passive income which is taxed on the US tax return for a non-resident will be taxed at 30% flat rate. And for dividends from the US corporation, that has to be taxed at 30% or at the treaty rate. I think treaty rate is around 15%, and the lower of the two will be considered for taxation. And any interest they earn in the US, like the bank interest, won't be taxed in the US. As I mentioned, the capital gain will not be taxed in the US when they are a non-resident, and rent and the royalties which they get from a foreign country won't be taxed as a non-resident. If they have a house in the US and if they let that out and get some money out of that as a rental income, that will be taxed at 30%. The gross rental income will be taxed at 30%, and no deductions or expenses will be allowed as a non-resident. But again, there is an exception. If they make election and to treat that as effectively connected income in the US, then they get to take all the expenses and depreciation, and net rental income will be taxed at graduated rate.
Can you know whether capital gains arising in India for a resident US citizen, whether they have to include that capital gains amount in their income tax?
Yes, they have to include the capital gain because they're taxed on worldwide income. They have to report the capital gain, and if any taxes are paid in India, they can claim that as a credit on the US tax return.
They have to include that.
How does it work with you saying that capital gain is not taxable for US citizens? For non-residents in the US?
For non-resident, it's
No,
not
for
taxed.
residents.
For resident, it's
US
taxed.
citizen, yeah, they are US citizen.
It's
So that has
taxed.
to be included,
Yes.
maybe in their return.
Yes. So that's about the income recognition and how the residents and non-residents are taxed in the US. So the tax forms, non-resident files his tax return on form 1040 NR, and resident files the tax return on form 1040. So that's a two-page summary they have, and there are various schedules and attachments which goes along with the tax return. And some of the schedules I have listed here. One is Schedule A, that reports itemized deduction, again that reduces the taxable income. Schedule B is to report the interest and dividend income, and C is for business or self-employment income. And Schedule D reports the long-term and short-term capital gain in the US, and the capital gain from Indian shares or Indian entity is reported on Schedule
There I
D.
got one small clarification. For income tax capital gains, after computing the capital gains, it is found that capital gains is nil in India for Indian income tax gains. But can we claim the same exemption in US return also as well?
No, you have to go by the.
Assume that I have calculated the capital gains and a certain amount of capital gains is there, and I claim the exemption because of the basic rate and other things. So, as far as India is concerned, their capital gains is nil. For same thing, can we claim it even in US also? US return as well?
No, you cannot claim the same exemption in the US. It is taxable in US for a resident.
It is taxable.
That's what I want to clarify.
The methodology of computation might be different, sir. So the methodology of computation, where here you use 45, 48, 49,
Yes.
and the slab rates, section 54, I mean, that may not be applicable, but the methodology, cost of acquisition, index cost of acquisition, fair market value as of 2001. So that is very specific to India. When we go to the United States, as
Yeah, is there any methodology like that, like whatever we get that 54 and 2001 basic indexation and things like that, all those things, do you have the same type of thing even in US tax laws?
In the US there is no indexation.
Indexation?
There is no indexation.
It's the capital gains is a straightforward calculation. Sale price minus the adjusted basis, the tax basis, whatever you have. Right, that's the cost.
Actual cost or adjusted cost?
What
Well,
do you
we call it as an adjusted tax basis. So when we compute a capital gain,
There is indexation.
there's no indexation. So for example, if you're talking about a depreciable asset, right? So the adjusted basis would be cost price minus the depreciation. That's claim is your adjusted tax basis. So sale price minus your basis.
Now, if it is a case of real estate, the question of depreciation does not arise.
Yes.
So in which case, what is the adjusted price like?
In that case, it is the actual cost.
Actual.
Yes.
Actual cost.
Cost.
Actual cost, we can claim the exemption.
Not an exemption. Sales price minus the cost is your gain.
Even though if it is ancestral property beyond 1961.
Okay,
Before
when
like-
you receive, that's we are getting into a bit more specific into the inheritance, right?
Right, it will be the cost basis to the previous owner. So we have to look at the gift and inheritance.
Gift and inheritance.
ignore that.
Is how do you?
That's
So the basis actually carries forward. So in the US rules, there are two different types of transactions in general. On the corporate side, I'm not aware of the individual side. If it is a taxable transaction or a non-taxable transaction, wherever there is an incidence of tax when the transaction occurs, then the cost basis would be fair market value because it is already taxed. If the transaction is a tax-free transaction for the payer and the payee, where no one is paying any tax, then the basis carries over. Whatever is the basis in the hands of the payer would carry over to the payee as well, right? So that's mostly on the corporate side. Similar rules apply even on the individual side overall, whether it's a taxable transaction or a non-taxable transaction.
So indexation, since it is not applicable in US, what would be the real reason? Is it because of the inflationary trend in India, that's why they adjust this indexation?
Yes, indexation,
Because
the inflation is not so much in the US.
Inflation is there.
No,
Even
but
in-
then certainly not compared to what India is having.
Yes.
So is that the reason, or?
Yeah, inflation is not so much in the US, so there is no concept of indexation.
And the other thing is, I think that LTCG is different. There it's more than 1 year, and here it is.
The long-term capital gain and the short-term capital gain. The individuals will have a different tax rates, but at the corporates it's all the same.
There it's for everything it's 1 year. 1 year is short term, less than 1 year, less than 1 year is short term, and more than 1 year is a long term. Okay, and the 60 to 51 is for reporting the alternate minimum tax for individuals, and as I mentioned, they will be subject to 26 or 28% AMT.
Yeah. And I think one more form here is form 1116 for the foreign tax credit.
Yes, Form 1116 is to collect the foreign tax credit. I did not include that here. So the list goes on.
Yeah.
So I just included a few of them to show an example of how it looks like. So that's about the taxation for residents and non-resident. Like we learn how the residency is determined and how they're taxed in the US. Let's move on to some of the additional filing requirements apart from the tax returns. These additional filing requirements are mainly for the resident. When I say resident, it includes citizen, green card holder, and the people who meet the substantial presence test. The first one is the F-bar or FinCEN 114. So you might have heard about this form, and if you have clients who are filing the return in the US, they would have spoken to you about this F-bar. If a person is a US resident, and if the value of the balance in the foreign bank accounts, that's non-US bank accounts, or the financial accounts, exceed $10,000 during the year, at any time during the year, then they have to report that to the US Treasury Department by filing this FinCEN 114. This form has to be filed online, and the same filing deadline as the tax return applies to them. And there is an automatic extension without even requesting an extension. It gets extended until October 15. So for 2017 tax year, if a US resident had in a bank account or financial accounts in a foreign country and the balance exceeded $10,000 by applying the treasury rates, treasury exchange rate, then they have to file this FinCEN form. And if they do not file this form, the penalties are very severe, and the basic penalty will be $10,000. And if there is intention to hide this information and they don't file it, then it may go up to like $100,000 or to $50,000 or 50% of the balance in their foreign bank account. And this is mainly to avoid people shifting money from US and putting it into like tax havens and not reporting that. So that's the reason they have this FinCEN form.
It's only to be reported, not to be taxed.
There is no tax, it's just a reporting. It's a reporting form.
Do your like your securities balance and your PPF and all that qualifies for that impact? Is
Uh,
it only bank accounts?
It's not just the bank account, it's all financial accounts. And if they have any investment account or broker accounts and like a trading account, so everything has to be reported. So there is no penalty if you over-report or report everything, whatever you have, but there is a severe penalty if you don't report. So the best option is be conservative and report whatever the foreign investments you have.
Like if you invest in a corporate fixed deposit directly, then that has to come.
Yeah, that
All
has to be
financial assets.
all financial
assets need not be
assets.
declared.
Yes. Yeah, even that has to be reported.
I think that is very similar to the Indian black money law as well, where you are required to you have stringent penalties for not reporting. So I think all countries are converging in terms of citizens having assets and cash or bank balances overseas. So it seems like we are also pretty similar there.
So you include all the wallets also, right? Paytm and all these small wallets that we have.
The $10,000 balance you may not hit in terms of
It's aggregate, right? $10,000 is an aggregate.
It's in aggregate, right?
It's an aggregate. So you have to look at the balance in each and every account. If the total of that exceeds $10,000, then you have to report all the financial accounts.
Between the Paytm wallets, all that has to.
Yeah, if you have 10 accounts with $1,000, all 10 have to be reported.
The online transaction, the Paytm is kind of a new to us. I mean, we haven't come across those kind of
All
online
Paytm accounts
wallets.
are now bank accounts.
Sorry,
All Paytm accounts have been converted into bank.
then it's safe to report that. And then we look at the cryptocurrency also, I mean, Bitcoins and those things, so they have become a popular thing now. So there is no clear guidance on reporting that because that's considered similar to currency, but the US might come up with the guidelines on reporting cryptocurrencies as well. Similar to FinCEN, there is another form, it's called as FATCA form. So you might have received this message from your mutual fund houses or from your bank accounts to declare this FATCA. So what this form refers to is it's again a statement of specified foreign financial assets. So this form has to be filed along with the tax return with the US tax authority. The first one, the FinCEN, goes to Treasury Department, the second one goes to the tax authority. Here the filing requirement is different. If if a single filer has more than $50,000 at the end of the year or $75,000 during the year, at any time during the year, if the balance exceeds that, then they have to report that on the form 8938. If they are married, then the limit doubles, it's 100,000 and 150,000. And if someone is a US citizen living in a foreign country for a long term, then that gets doubled to 200,000 and 400,000, the limitation. So that's again based on the filing, the marital status or the filing status. Again, this form has to be filed along with the tax return, and if they don't file this form, the penalty is up to $10,000. Even the accounts which are reported in FinCEN has to be reported in form 8938. And even if the corporate level also they are required to file FATCA.
Yes, FATCA is an intergovernmental agreement that every country, they would collect that information and submit to the governments, and the governments enter into an agreement to exchange the information. What is the bank account of financial interest that they have?
If by oversight this was missed, can we now file it like last 2-3 years together?
You can file for FinCEN. For FinCEN there is a overseas voluntary disclosure program under which you can file and ask for abatement of penalty. Even 8938 you can file with the tax authority and you can let them know the reason why you did not file it earlier. If it's a genuine reason, they abate the penalty. So I have not come across any situation where they have levied the penalty on missing form 8938, but there is a provision to levy the penalty. So there are various other additional forms the US citizen or resident have to file. The first one is the passive foreign investment company or form 8621. If someone holds a passive investment in a foreign country, best example is a mutual fund, and then they have to report that in form 8621. Any Indian person who comes to the US and is filing as a resident in the US, if he holds mutual funds in India, that has to be reported on 8621. Again, there are certain exceptions to reporting that. If the balance does not exceed $25,000 for single or $50,000 for married filing joint, and they have not made any election to make a mark-to-market or a qualified election, then the reporting is not required. Otherwise, I have to report the mutual funds. Any dividend issued by the mutual fund will be taxed and again will be calculated on 8621. There is something called as excess distribution. We look at the last 3 years of average, 125% of that. If any distribution in the current year exceeds that 125%, then that will be taxed at the highest tax rate of 39.6%. And the current year dividends are taxed at the regular slab rate. If they sell mutual funds, then again we look at the excess distribution, and the gain they make from the mutual fund will be taxed at 39.6%. So there is a lot of reporting requirement for holding the mutual funds in a foreign country. So if you have your clients who are filing as a resident in the US, maybe they would be contacting you for these details, because US, the tax preparers will be asking for these details.
Is it true that you have to mark to market the mutual fund every year, and even if you have not sold it, you have to offer that for?
It depends on case-to-case basis. That's again an election, and
that is there are three regimes. Like there is a penalty regime, there is a MTM regime, and there is a PFIC regime. So we have to opt into one of those. So if we don't opt either as a PFIC or an MTM, then we will fall into the penalty regime whenever there is a distribution. So that's a PFIC is a very risky area, and we run into a lot of issues there.
If you that in the form itself,
it's there in the form. It is 621. They have to make an action. And the next one is about the US person holding shares in a foreign corporation. If a US person holds like more than 10% of the shares in a foreign company, then that has to be reported on 5471, and there are stringent rules again with those holdings. If the total holdings in the foreign corporation by the US person, when we say US person, the person should be a US resident holding more than 10% of the shares of the voting power, and if that exceeds 50% in a foreign company, then that's called as controlled foreign corporation, and there are various filing requirements on that. So the basic thing is, if someone holds more than 10% in a foreign corporation, a US resident, Form 5471 has to be filed. And the last one in this list is the transaction with foreign trust. And if someone and receipt of a gift from the non-resident, if a US person, US resident receives gift from a non-resident, and if that gift exceeds $100,000 or $1 lakh, then that has to be reported on Form 3520. If someone is a US resident and their Indian parents, grandparents give them something, or if they inherit their property, and if the value exceeds $100,000, then that has to be reported on Form 3520.
Should be valued as per the basis of the home country.
That will be it will be on the basis of the home country, and the value on the date it's transferred or it's gifted. So we need to look at the market value on the date, and if that exceeds $100,000, that is reported.
Only reporting, there is no tax.
On the gift from a non-resident, there is no tax. So the gift is usually taxed in the hands of the donor if the donor is a US person. So the next important thing is the relinquishment of citizenship or green card. So for this we need to look at two definitions. One, we need to understand, we call them as expatriates who relinquish the green card or citizenship. We need to see who is an expatriate. A citizen is always, if he surrenders his citizenship, he is called as an expatriate. Or a green card holder, if he is a long-term green card holder, that means he holds a green card for 8 out of 15 years from the date of surrender of green card. We go back 15 years, in that 15 years, if he held a green card for 8 years, he will be considered as a long-term resident and will be called as an expatriate. So they will be subject to additional tax, and let's look at the next slide. Once they are considered, once we determine them as an expatriate, then we need to see whether they are considered as a covered expatriate. So if they are just expatriates, then they have a filing requirement, a reporting requirement. If they are called as covered expatriate by meeting these three conditions, then they have to pay taxes. And first let's look at the conditions and then let's come to the tax impact of it. So if the annual 5-year average of annual income tax for the last 5 years exceeds $162,000, or their net worth is more than $2 million in that particular year when they surrender the green card, or on the date of surrender of green card. And if in those two cases their card is covered expatriate, then whatever the assets they hold are deemed to be sold on the date they surrender the green card, and if there is any gain arising out of that, that will be subject to tax in the US. So we look at the fair market value on that date, and we look at the cost basis of acquiring that asset, and if there is any gain, then depending on the nature of the gain, it gets taxed on the US tax return. If someone is a long-term resident and had not complied with the US filing requirement in the last 5 years, then we don't look into these two conditions and they are automatically considered as covered expatriate, and they are subject to the expatriation tax. So we look at their asset, the worldwide asset, and it's deemed to be sold on the day they surrender the green card, the gain gets taxed. So that's why they have to be, I mean, if someone has a plan of surrendering their green card, they have to be aware of this expatriate tax and what impact it has on their tax return. So once they surrender their green card, they will be considered as a non-resident from the date onwards, and then we need to look at substantial presence test for the residency. So that's in a nutshell about the US taxes, the residency requirement, the filing requirement, income recognition, and additional filing requirements. So I have a few slides covering the tax reforms. So there was a major tax reform which happened during the month of December of 2017, and that will be applicable from 2018 tax year. And some of the key provisions which impacts the individuals are, one is the tax rate. There are 7 tax brackets and the range has changed. The highest tax bracket has reduced from 39.6 to 37%. And child and dependent care credit, they used to get $1,000 as a credit, and there was a phase out if the income exceeds $75,000 or $110,000. But now that's increased to $2,000 as a child tax credit, and the phase out happens at a higher range of $400,000. Again, pass-through entities, and maybe Raghu can cover that on the qualified business income. There is certain deductions they can take now. And foreign property on Schedule A, when we claim the itemized deductions, they can claim deduction for real estate taxes or the property taxes. But that's taken out, the taxes paid on the foreign property is taken out in the tax reform. It's not allowed anymore, and only if it's a rental property that can be claimed as a deduction against rental income. Moving expenses, currently people were allowed to claim moving expenses when they shift from one place to another place, one country to another country. And going forward, even that moving expenses are disallowed or it's eliminated. State and local tax, currently whatever the state and local taxes they pay can be claimed as a deduction on the federal return, but now they are going to cap that to $10,000. Itemized deductions, currently there is a phase out happening. If the itemized deduction is $70,000 and his income is $600,000, probably he won't get the itemized deduction because he is a high earner, and that is going off in the current law. And the standard deduction is being doubled. It's changing from 12,700 to 24,000 for married people, and the personal exemption is going away. There is no personal exemption allowed anymore. That's adjusted in the standard deduction. So these tax reforms are kind of pointed towards the low earner income so that they don't have to pay too much of taxes, and that's why there is a higher deduction and higher credits available. So those are the key provisions from the tax reform. There is a 1,000-page document which talks about the tax reforms. I just picked 6 items from that for individual taxes. So that's about the individual taxes. Any questions you have before I hand it over to Raghu to talk about the business
You mentioned a US resident, or a person who's a resident giving a gift as a donor. He's going to be taxed. What is the tax implication on the donor gives a gift? And is that gift to anybody, like blood relatives also?
Yes, there is a separate provision for that, and they can gift up to $14,000 to one individual. And there are the bigger threshold they need to look into. There is a gift tax is separate from the individual taxes. So up to I think 1 million they can gift and it has to be reported, and there are tax implications beyond it. I'm not well versed with the gift tax, but there is a tax provision if a US person gives something to the other people. I mean, it need not be blood relative, it can be anyone.
And just one more question is, a person in India who's a resident, he only has to file the federal taxes. If he doesn't have any home anywhere in any state of the US, it's okay if he just files the federal tax return, or he has to file any state tax return?
No, just the federal is fine. If we don't live in any state and don't have domicile in any of the state, then just the federal tax return.
Also have to break the residency, right? If they have established residency and if it's not broken, they still need to file a state tax.
Right. Once they establish domicile, as I mentioned, a person can have only one domicile. If he was a domicile of a particular state, and if he moves back to India, then he has to prove that he has moved his domicile from that particular state to a foreign country, and that means he breaks residency in that state, and then he won't be taxed in that state.
But they have their foreign bank accounts, like in the US banks, they have their accounts. For that, they have to give a local address. That won't qualify as a domicile.
No, that won't be a domicile. For domicile, we have to look at the bigger picture, where his family is and where he intends to live.
Sir, for US green card holder, rental income beyond in India is taxable there?
It is taxable.
What should we do here also?
Yeah, then as I mentioned, he can get foreign tax credit for the taxes he pay in India on the US tax return.
They can get that tax?
Yeah, in US, because it's a foreign tax.
Sir, I would like to ask a question on behalf of all the freshers sitting here. Based on the complexity and the different types of taxes in US and India and the upcoming reforms in 2018, as you said, what are the scope for a newly qualified chartered accountant in US taxation as well as in Indian taxation? If you can tell something about that.
It's huge. I think I will address that when I get up.
With regard to MNCs in India, in India's days, they usually they give the ESOP and the shares are sold in US. The person director, he being the India resident, where he don't have the green card holder as well as he is not resident in US. There is a director in India for MNC. When the shares comes when they sell the shares, the amount repatriated to India, and they withhold the tax of the capital gain or whatever. And how to claim that in India? Because whether that covers, because it comes in Form 16 also, that is all covers in Form 16 in India.
Okay, the taxes are withheld in the US. The only way to claim the taxes back are by filing a non-resident tax return in the US.
It has to mandatorily file the return in US for that.
If they want to claim the taxes withheld back, then they have to file tax. And there is no other way to get it back once the taxes are withheld and remitted to the government.
If he has not filed the return, then he has to disclose that the capital gain what is sold there in US, which is in ESOP as in the lot. That has to be disclosed in Indian return, right?
Otherwise also he has to disclose. Otherwise also he has to disclose because it's the Indian income.
Indian income. So global income has to be taxed.
Global income would be taxed in India. Then you are paying foreign taxes, you should be able to pay credit here, subject to the rules and
Suppose you want to claim that credit, then he has to file the return, then only he has to claim here. Whatever the taxes they are doing.
Are you able to file the return if you don't have the SSN?
You need to apply for the individual taxpayer identification number. There is a process.
Even if you don't have the SSN, it's fine.
Yeah, it is for the people who don't qualify for SSN. There are again rules to apply for IT.
That must be very time-consuming and quite, long process.
Usually they have to send, they have to put their foreign identity and send a passport as well as a backup for that, and then they can apply for IT. It's a complex process.
So just an additional question to what we had asked. It's only to claim the tax credit, but not claim the refund of the taxes withheld in US.
So to claim the credit in India for the taxes withheld in US.
Right. Can he claim a refund in US instead of claiming it in India as a tax credit? Can he claim that since he is not a citizen or a resident of US, can he claim that?
Can he claim that as a refund in US?
Yes, since he is not subject to tax in the US, but there is a withholding.
Right.
Then he has to file the tax return and claim it as a refund.
So when he claims as refund, he cannot claim it as tax credit in India.
Yeah.
Right.
I think so.
Just that I think this is there was a question on the same point gentleman said, whether it's rightfully paid. So if your taxes have been rightfully paid in the other jurisdiction, then it's right for you to claim credit here. But you don't want a situation where you claim a refund in the US and then with a Form 16 like equivalent come here and claim credit with the assessing officer. That would be incorrect. Patently.
Okay, with that, I will hand it over to Raghu to talk about the business provisions and risk management.
Can you hear me? Yeah. Thank you. So we have very less time for us to cover, but I will do my best to give you a snapshot of what's happening on the US tax landscape. And most of you would have heard about the tax reform recently. Have any of you have experienced or have been impacted because of the tax reform? Anyone has any insights into the tax reform here? So this is a $1.5 trillion loss budget that was passed by Trump administration, and the tax provisions that just Kariyappa has covered that impact the individuals, they amount to almost 1.2 trillion over 10-year period, and there is a significant impact, there is a significant changes that have been made to the tax reform since the last time that the US tax code section was revamped or have gone through this reform is in 86. After 86, after 30 years, this is the biggest tax reform that has overhauled, changed a lot of provisions in the US tax. But it has been done with rocket speed, and we have. It's very surprising that such a voluminous tax reform with significant impact has been passed in a very short time frame. And trust me, we are going through that, and every week we are receiving notices, we are receiving further guidance, and as we speak, we are working through a lot of the provisions. So if we look at the tax reform, initially the idea was that when the notification came and there were political announcements that the tax reform would change and simplify the entire landscape, and we are going to move into a territorial and not a worldwide system. Like you have asked, we all thought that the tax law would be very, very simple. It's going to be, it can be automated, or we can write some Excel macros, and we don't have to spend a lot of time. But trust me, once we started looking at this, what he has done is already the US tax law is very voluminous, very convoluted. On top of it, there were additional provisions that have been introduced, and it became murkier and if not clear, right? So it has become much more complex and much more intricate for us to deal with a lot of these provisions. And it has been amazing learning, looking at a lot of these provisions and understanding what's happening. So the whole idea of the new tax reform is to bring in or to pass on tax benefits to the taxpayers. And as we have seen in the previous slides, $1.2 trillion of benefits. And there are only few, but there are other provisions that have been passed in the Tax Reform Act, the Tax Cuts and Jobs Act 2017. That's 1.2 trillion, and the remaining goes into the corporate side. So today we'll briefly cover this very, very high level. We do not have sufficient time to discuss a lot of these provisions. I would love to, but we do not have time. So we'll sort of telescope into a lot of these provisions and give you a snapshot of what these provisions are, what changes have been made. The biggest highlights of the tax reform is one, it has brought in a lower tax rate. Individuals, we have already seen 2%, but the biggest tax rate cut is on the corporate side. From a 35%, it came down to 21%. At 21% tax rate, and it's it's significant for the US. There are a lot of implications, a lot of opportunities coming up. So what do we do? I mean, when there is a tax rate change, right? There is a lot of planning goes on. So now I have an opportunity to, and I'm paying the 35% tax rate, and next year it will be 21%. So I want to accelerate a lot of my deductions in the 35% tax rate rather than in the 21% tax rate. So there is a lot of planning going on there. And the new international system is, the announcement says that it is moving from a worldwide system to a territorial system for the corporates. So where they are saying that if you earn income only in the US, we will tax it. If it's outside US, we will not tax it. But it's not a territorial system once the act was signed. It's more of a modified territorial system, I would say. Still, there is the taxpayer base has been increased. There are a lot of new provisions have been introduced to bring in a lot of other corporates and the shareholders that were not paying tax. And even if some of the provisions we will see, which will make clear to us how the system has changed. So as we discussed, the corporate tax rate has reduced from 35% straight to 21% with effect from 1st January 2018. And what it does is for the fiscal year corporations, if you have an Indian corporation and if their parent is also in the US, which is also following the fiscal year, now how does it apply? Right, so we need to use a blended rate for that, wherein you have to look at it, 9 months is 35%, 3 months is 21%. So you have to prorate it and apply the tax rate. And the alternative minimum tax system that we discussed on the individual side, that has been eliminated on the corporate side. Now when the corporate AMT has been eliminated after 1/1/2018, again the fiscal year corporations, the Indian corporations pose a challenge. My beginning AMT is 20%, and now my ending tax rate is 0. So how do I compute my AMT? Because the corporate is 9 months into AMT and 3 months into 0 AMT. So how do we do it? It's tricky. Another biggest thing is interest expense limitation. A lot of or people that are speaking, a lot of you already know about the thin cap rules. There is section 163J interest expense limitation. Earlier, when the US taxpayer makes a payment to an interest expense to a related party, there is a thin cap rule based on the debt equity ratio. That has been done with. It is been repealed, and a new 163J has been formulated, wherein it's much more stricter. Now the entire interest expense is subject to 30% of adjusted taxable income. Again, what is adjusted taxable income? There are definitions. A lot of these provisions have been phasing in or phasing out. So there are various dates that have been going around. So up to a certain year, it would include. It will not exclude depreciation and amortization. So you have a bigger adjusted taxable income. But after some time, the depreciation, amortization, it would be after depreciation and amortization. So it would be a lesser ATI. Your interest expense would be very less. Now, when the old 163J has been removed, if you are aware of the provisions, there are certain carryovers that have been there. So earlier, a corporate was disallowed some interest expense under the old 163J. Now, what happens in the new 163J? What do I do with it? I couldn't take a deduction earlier. So now, how do I deal with it in the new 163J? Again, there are rules and notifications that are being introduced. Then on the domestic side, 100% expensing of qualified property. Again, this is not a first year expense. Like you could just write off. So certain qualified property can be placed in service after a particular date, 9/27. After 9/27, if it is placed in service, then it can be written off 100%. It applies to certain qualified property, and then it gets phased down over a period. And then another biggest reform on the domestic side, domestic corporation side, is net operating losses. Earlier, net operating losses were carried back for 2 years and carried forward for 20 years. You have a similar provision, carry forward NOLs in the corporations on the India side, right?
Yeah, so carry back.
Carry back too. So now that has been done away with. The old NOLs would still remain, and they are subject to 20-year carry forward rule, but the new net operating losses that are generated after in the tax years after 12/31/2017. Sorry, when I said 12/31, I'm talking about MMDDYY, the US format. So after 12/31, again they are indefinite carry forward, and they can only offset up to 80% of the taxable income. And in the US there is another. So all these provisions, we look at it. I mean, we need to understand what is the existing. If we understand the existing provisions and what has changed, then it would be sort of, we can make a good sense out of this. The next one is biggest change on the domestic side is on the like-kind exchanges. Section 1031 transaction, where earlier if you exchange a property for another property and if there is a gain in the transaction, the gain is not immediately subjected to tax. You don't have to pay tax immediately. So it's a like-kind exchange. There is a provision. Earlier I could just exchange this desk with a chair or another desk and say that these are like-kind property, and so I don't have to pay tax. But now with the new tax reform, that has been limited to only to real property. Earlier, even though a lot of CFOs, CEOs actually they change jet planes. They have their chartered planes and they exchange planes, and it is subject to like-kind property, and they don't have to pay any tax even if there is a gain. And that is done away with, and now it's only limited to the real property.
So here, will that apply to a situation where a person is, say, upgrading his home, right, in India? If he is a US citizen, living in India, is moving from a 2-bedroom to a 3 BHK. First he has to sell that 2 BHK and then buy a 3 BHK. Will that, qualify here?
Yes. So, so I do not again know about the citizenship. That's his area. My area is corporate. So yes. So if a corporate, for example, the corporate, there is a building that they have an office building, and they are moving from one building to the other, and they are exchanging the property, then yes.
Only for corporate?
Yeah, I'm talking about the corporate provisions. So I mean, we are very deep into code sections and regulations. Dividend received deduction is another. If they receive, if a corporation receives a dividend from a 20% or less than 20% owned corporation or a subsidiary, then they are eligible for a dividend received deduction. Earlier it used to be 80% and 70%. Now they changed it. They reduced it to 20 and 65 and 50. The next year, the first year expensing, there is a typo there. But first year expense, sorry.
Can you repeat the carry forward provision?
For the net operating losses?
Reform.
This one? Yeah, the net operating losses that are, they have an indefinite carry forward. Earlier, the losses that were generated prior to 2017, they are carried forward 20 years. Right? Any net operating loss that is generated in taxable years after 12/31 that begins after 12/31/2017 is unlimited carry forward. So indefinite period they can carry forward. But the net operating loss carried forward can only offset up to 80% of the taxable income. Earlier, in the previous prior to the tax reform, I was able to take the entire net operating loss, offset my taxable income. I have $10 million of income, I have $20 million of net operating losses, I don't pay tax. But the tax reform will make sure that we at least pay tax at least on the 20%, right? And what is interesting is after 12/31, we are not allowed to carry back net operating losses. And that's for obvious reasons. If I generate a loss in 2018, which is at a 21% tax rate, I have an income in 35% in 2017, I can carry back the 20%, 21% NOLs into 35% period and offset my tax there. So that carry back provision has been stopped as well. Does it answer the question? Thank you. The first year expensing, there's a typo there. The first year expensing is a section 179 expense on specific qualified property. The definition of qualified property has again has been expanded. it is eligible up to $1.5 million. It's up to $1 million deduction. Earlier it was $500,000 first year expensing, now it is $1 million deduction. And domestic production deduction is in section 189. Earlier for corporates who are having activities, they are eligible for a 9% deduction based on certain criteria. That has been repealed. International provisions, this is where 7:50, I think we are 10 minutes into the... So I'll stop here before I move into the international. Anything you want, any questions? I know I'm going at a very fast pace, I understand that, it's just the time constraint. Okay? So we'll move into the international provision again as we discussed.
The young man out there had asked a question about, so you might want to answer
that question, right? So yes, as you are seeing here, a lot of provisions have been changed, and even I thought that what I'm going to do after the tax reform, right? That's the thought I had. But trust me, this opens up a lot of opportunities for planning, lot of opportunities for cross-border structuring. Some of the provisions that we are looking at now, which is on the slide, like a transition tax. Earlier, in a cross-border scenario, when you have a US parent and a India subsidiary, and the profits in the India subsidiary are retained in India and not repatriated back into the US because they are subject to the taxes in the US, and I was able to defer and not pay taxes. And this is clearly keep in mind some of the large corporations, right? So now that has been, there is a cap for that, there is a transition tax that is coming up. So some of these provisions have been introduced which make things more complicated, gives us more opportunities to look into, and now this is the time when you need to understand both laws. I mean, if I know only US side, I wouldn't be able to properly advise my clients or tell what I need to do, right? So if you have India tax background, Mithun is a classic example here. He's got an India tax background, and then he also has been in the US and worked with the US clients there, and he understands both sides of the world, right? Then you will be able to bring a new perspective to the clients, and you are much more valuable than someone who knows only one side of the coin, right? So it's a lot of opportunities for youngsters, a lot of opportunities. Then the transition tax we just discussed briefly is a deferral, right? Earlier we used to defer using the CFC situation. Now it's deemed a repatriation. Even if it's not repatriated, it's deemed to repatriate, and it's subject to taxes. It's a 15.5% for cash and cash equivalents and 8% for non-cash equivalents. So this is sort of trying to bring in the money into US, right? And then there is a dividends, foreign source dividends are not subject to tax in US now. Again, they say that it is foreign source dividends are not subject to tax, but they will tell you what is that foreign source. So it's not, again, simply there is a definition to that. Again, some of the provisions that you see on this slide, they are very interesting. They are trying to broaden the tax net and increase activity within the US. And there is a carrot and stick approach. The stick approach is trying to tax the global intangible income, where the taxpayers park their IP outside US and earn money there in their CFCs or the multi-tier corporate structure, and that is not subject to tax in the US. So some of the intangible income which is not subject to tax or subject to tax at a lesser tax rate is now brought back into the US, and it would be taxed based on the rules. So the way the rules would work is, if your global intangible income, and the name is GILTI, right? So we call that as a GILTI income. So if GILTI income is taxed at a more than 13.125%, then there is no additional tax burden in the US. If it is less than 13.125% tax rate outside the United States, then the US tax rules would bring it in or make a annual inclusion in such a way that you would at least pay 13.125. Okay, so there is a calculation that goes on there. And then there is the carrot to this is FDII. When the domestic production activities has been repealed, where they do not get benefit for domestic manufacturing activity, whereas on the other hand FDII is introduced, foreign derived intangible income, wherein exported IP. So if you are receiving income for services or goods performed outside the United States, then you would get a beneficial tax rate that would be taxed at 13.125%. So you will get a 37.5% deduction. So on the remaining 62.5%, you pay at 21% tax. So eventually you are paying only 13% tax on your income, IP income. So that's a good opportunity for taxpayers to bring in IP back into the US, or try to keep their IP there. BEAT is again is a very big provision. Is huge impact to a lot of IT and service sector, especially I've seen a lot of Indian companies will get impacted because of this. The BEAT is a base erosion and anti-abuse tax, wherein earlier there is a transfer pricing between a US entity and a foreign entity, and they used to make payments to the foreign related party and shift their bases, like they reduce the bases in the US and move the bases, or they hold the value in India. So wherever they are doing this base erosion payments, based on certain threshold and percentages, they would cap that and say that those payments will now be subject to tax. So if any US holding company making payment to their software development center, a subsidiary in India, they are making payments, all those payments would now be subject to like 10% tax at a gross level. That's a big impact. There are provisions on to whom it is applicable, what are the types of taxpayers who will be subject to that, and there is a 500 million gross receipts threshold. We need to look into that, but BEAT is a significant impact.
Will it be withholding or will it be taxation? In this case,
on the BEAT, it's a tax. It's a tax. And BEAT works like a minimum tax.
Okay.
So the way it works is, I did a Excel model, and if the base erosion payments is more than 52% than my net income, then 50% of 10% is taxed. I'll pay 10% tax. So I take my regular tax, and then I take my modified taxable income. I would calculate under the BEAT provisions. And if my modified taxable income, 10% of modified taxable income is higher than my regular tax, then remaining I just pay it as a BEAT minimum tax.
There is a question for someone.
FDI, similarly, what the US government is trying foul about the Indian companies getting export benefits. You don't do WTO for that. Isn't that the same thing that FDI?
Yeah, so I do not know about the Indian scenario. What's happening? I do not know what is being done. But in the US side, the FDII is to capture or encourage taxpayers to export services or keep the IP in the US. Earlier, a lot of IP is being moved out of the US because they don't want the IP income to be taxed in the US at a 35% tax rate. And they put it in offshore entities or offshore vehicles where the tax rate is low or zero, like Cayman Islands or Virgin Islands, some of those tax havens. Now they are saying that you don't have to do that. If you keep your IP in the US, then you will pay a 13% tax on it, which is significantly less.
And BEAT provisions are similar to transfer pricing provisions?
BEAT provisions, well, it's not similar to transfer pricing. So there is a transfer pricing. Whenever there is a payment, there would be a transfer pricing, right? So if we do not have a transfer pricing adjustment, Section 482 adjustment, then it would be an add back or there would be a penalties. This is not that. This is much more broader than that. What BEAT does is, if you take an example of a US corporate with an India subsidiary, if US corporate is making payments to India, and what they do is all the activities in India, and they are making all the income that is on contracts are all done in the US. The contracts get signed in the US, but the US would shift the entire income back into India, right? and they make payments like royalty payments or interest payments for which the US will take a deduction. What they are saying that because all those payments that you are making to your related party are creating deductions to you and eroding your base, or the base is in the US. So I think all those base erosion payments will now be brought into US tax net, and they have to pay a minimum tax.
So just to compare this with the BEPS, actually it is in line or probably in line with the thought process of BEPS.
It's almost in line with BEPS, and then this is impacting a lot of cross-border or multinational entities and clients significantly, right? Because the way they are structured now is that they do not report a lot of tax. There is just the transfer pricing and a lot of income, or the value is normally trapped in the offshore entities.
The nomenclature is also base erosion, so it's right up there. So it essentially impacts a lot of outsourced vendors. If you have a subsidiary in India, you're a $500 million corporation in the US, and you're making a payment to your Indian sub. But nonetheless, wherever there is a tax, there is a loophole. So there are structures which people are looking at to avoid this.
So US is not a member of the BEPS, so I think to avoid that they have introduced wheat just to ensure that the BEPS is there in the rest of the world. In US they have wheat. So I think that would be right.
Possibly, but many of these measures which are not treaty driven are subject to local countries to pass legislations. So even we've got equalization levy, we've got Section 94D. Many of these provisions, Section 9 got amended this year in the budget. Individual countries are left to their own discretion to pick and choose what they would like to do.
What are the conditions they identify for seeing that base erosion or anti-abuse is operating? Is that FPR analysis now in the transfer pricing? They do it here.
No, it's a completely different thing. There are a set of conditions. You need to be a $500 million corporation, and you're making certain payments, which is
functions, assets, and
it has nothing to do with functions, assets, and risks. So
nothing to do with functions or anything. If they are making a payment, if they have to be an applicable taxpayer, which is a corporation, or it could be which is a corporation other than a RIC, REIT, and S corporation, and then they have to have a $500 million annual gross receipts. Then they will be subject, or then we will start looking into the wheat applicability. Then we need to look at their base erosion payments. If the base erosion percentage is 3%, if the payments that we are making is reducing it by 3% of the taxable income, then the wheat provisions would apply, and then we would calculate the minimum tax. Wheat is almost like a minimum tax, and this is the biggest thing. The cost of goods sold, if the US entity is paying money to India for getting goods, it's cost of goods sold, right? So they're purchasing goods, then it is not considered as a base erosion payment. But if it is services, it is considered as a base erosion payment because they get a deduction there, right? So the entire amount that they pay to the Indian subsidiary is considered as a base erosion, provided they fall into the net. So these provisions have significant impact. So the idea of this session, or the purpose of this session, is not to sort of educate or create more knowledge on these provisions, but more sort of creating more awareness that there are a lot of things that are happening, and if you, your friends, your clients, your organization that you work with have cross-border transactions, have presence in the US, connected with US operations, then there are a lot of things for you to consider and start questioning. So if you could ask, next time when you see something, then is there a tax reform impact? I think that's sort of the objective of the tax reform. Otherwise each provision we can spend like 4 to 5 hours going through the example. These are quite huge provisions. So I think with that we are 4 minutes 30 seconds off our time.
So if there are any last questions, we can probably take a few questions and then wind up. So,
I think corporations, partnerships is me, individuals is that. India and US both do.
You know, we always keep hearing that US is more a friendly regime in terms of taxation and all that, but you know, I think having experienced that personally and looking at today's thing, doesn't seem like that. And I've seen many people who are not living in the US, who are residents, you know, because of the citizenship status or because of green card, they're actually thinking of giving up their citizenship or their green card because of the complication. But now there's also this exit tax that if you want to give it up, you know, there's a tax to, you know, exit.
Yeah.
So I don't know, is that the general
So
feeling?
I mean, 16 years I've been seeing the US taxes, and US is not considered as a friendly, tax-friendly country, because the whole idea of this tax havens and the Irish, the Apple, Google tax structuring and all of that, and parking money outside the US is all came because US is a high tax country, right? So high tax country, I mean, are there provisions which are making procedural activities easy? Probably they treat you well, but from a tax perspective, I mean, it is an aggressive country. I mean, it's always been a high tax country, and that's why there are a lot of structures that have been put in place to park money outside or create cross-border structures. So I think it has been, and with the tax reform, I think that point has been made and highlighted, I would say, and then there is a lot of effort to increase activity within the US. So there is a $1.5 trillion loss over a 10 year because of this budget, but this is expected to drive certain economic activity, because now they are saying, you know, because of BEAT or because of FDII, you know, you would not do these activities, so you would try to capture or bring in more money, and deductions would give you tax lower rates will increase or boost economic activity and, you know, bring in some money. That would be around 300 billion to 400 billion is what I remember. So yeah, it's been aggressive, and more than aggressive or not aggressive, from an academic standpoint, when I look at US tax laws, it's quite challenging and interesting.
But what you sort of have in terms of challenge with interpretation of US tax law, you have your challenges with managing the tax office. So you have a good share of that.
We have these big fours which have these centers around the world, right? They can easily collaborate and advise a client in that matter. So we don't belong to the big fours.
Yeah.
So how best can individual practitioners here collaborate with people in US or the other parts? How can that happen? Like, for me, I'm a practitioner.
Yeah.
Decent practitioner. Yeah, so how do you do that? How do you collaborate?
We really don't know. No, but I think in terms of building your own I think it's just whatever connections you have through your own sources. So
It's always
collaborate and
yeah.
perform.
And my career advice from my counselor is network. It all depends on your network. So you just have to network and find right people to help you out. You don't know the answer, at least you know who know the answer. That's it.
Post these US tax reforms, is there any change in US accounting standards or practices? US accounting procedure?
Accounting procedures. Yeah. So yeah, that's a very good question. So tax accounting has been a big challenge because of the tax reform. So for example, a small thing is we did not really know what to do. Like December 22nd, when we are on our year-end vacation trying to exhaust all our leaves, that's when December 22nd it gets signed, and we really didn't know how to respond or react to a lot of the situations. So a small example is the tax rate change. So when the tax rate changes, you have your deferred tax, right? So deferred tax calculation, you already have a deferred tax asset and deferred tax liabilities. What do you do with your deferreds? How do you value them, right? And in the US, we also have this valuation allowances. What do you do?
What are the major points of consideration you suggest to look up?
Yeah, so there are SEC staff guidelines that have been released. So one quick project is the transition tax has been for a cross-border entity. Transition tax has been the biggest impact. So one of the staff guidelines, SEC staff guidelines that we have read is that if you can reasonably estimate the provision, you should put it and mention that it's a reasonable estimate and disclose it. If you cannot make a reasonable estimate, then you have to disclose why you couldn't make a reasonable estimate. And if, by all means, if there are certain provisions for which the impact can be measured within the close of your tax year or before you file your financial statements, then you need to consider and report them. ASC 740 is, I would love to talk about it. There is ASC 740 guidelines are there. There are robust guidelines are there in terms of how do we deal with it. But yes, tax reform impact has to be considered. You need to look at your deferreds, what do you do with the valuation, and you also have to look at your realizability of those deferreds, right? Some of the
change in AS 606 also is a part of
yes. So that is a separate board, right? I mean, that's the separate institution. So after this, January 1st or 2nd week is when we started receiving the guidance on the ASC 740 and how do we deal or how do we disclose the impact of the tax reform on the financial statements.
Just to add on actually on this tax reforms taking place, I think companies like Google, Apple, who are actually having a very aggressive tax planning, I think they may have to look at their tax structures again and probably based on the tax reform they may have to again redo their structuring. Probably they may have to come back to US and pay tax free.
Yes. So that actually answers that gentleman's question. And what do I do? Right? I mean, it gives you more opportunities to plan. So accountant is the last one to get fired in an organization, right? The last minute he has to maintain the cash. So how it works. So that's what the biggest impact is, the immediate cash outflow, right? So the transition tax, and you fall into the transition tax, there's an immediate cash outflow that most of the companies were not prepared to, and they came to know about it on December 22nd. Right? And they're filing tax returns in September, and millions of dollars that they need to pay in transition tax. So yes, a lot of opportunities. So what we need to do, we need to closely look at our clients, friends, organizations, and start asking questions as to is there any impact. The minute you touch US, you say US, then there is something there. And this is something you always take a pause and say, we need to consult with someone.
I think we have run out of questions, but I hope this session was useful for you. As it was enjoyed.